Now that we've learned about liquidity ratios and stability ratios, let's go and apply them to Enron. See if we can see if there was any signs that the business was actually going to go bankrupt. So looking at its assets in the years leading up to its bankruptcy, we'd have to say no. I mean, it's got $65 billion of assets in the year 2000, which is almost double the year before. It did go bankrupt in 2001, so how do we explain that? Well, it's not in profits because profits went up other than 1997 every year, and it had actually achieved its highest ever profit in the year 2000, but we know it still went bankrupt in 2001. The share price clearly doesn't reflect a company that people thought was risky or financially unstable and couldn't pay its short-term debts as they fell due. But let's go and look at some of the ratios that we've learned about. We've learned about the working capital ratio. So for Enron, that working capital ratio in its last year of operations was only 1.07. What does that mean? It means for every dollar of current liabilities the business had, there were only $1.07 in current assets to finance them. So it's cutting it very fine. They only have an extra 7 cents for every dollar of debt that's due for repayment in the next 12 months. What about the quick asset ratio, which takes out stock and prepaid expenses and says how can we pay our current liabilities now based on our quick assets? Well, it was 1.04. So for every dollar of urgent liabilities, there was only $1.04 in quick assets to fund them, which is again cutting it even finer in terms of being able to pay our bills as they fall due. The cash flow ratio looked at could we pay our bills from operating activities, which is the ideal situation, and that's a terrible result. We can see it's 0.17. What does that mean? It means for every dollar of current liabilities that were due in the next 12 months, Enron's operating activities were only generating 0.17 cents. So that must mean that they couldn't not pay their bills. Where was the money coming from? Well, it must have been coming from either of investing or financing activities, and that's clearly not sustainable because we sell non-current assets that we can't use anymore, and financing means we're borrowing money, and that increases debt and our interest repayment. So that's a really bad result, and for every dollar of current liabilities Enron had in 2000, the operating activities only generated 17 cents in cash to pay them. Lastly, we've got our debt ratio to look at our stability, and we can see that was 82%. What does that mean? It means that for every dollar of assets Enron had by the time it went broke, 82 cents were financed from debt or liabilities. That meant owner's equity was only representative of 18% of assets. So that's not a good result. 82% of the total assets were financed with external funds rather than internal funds. So between the four ratios there, we can see a business that, if you're just looking at numbers and assets and profits, looks very successful. But in terms of liquidity and stability, those ratios show that it was actually a very risky company, and it wasn't as surprising as it may have been that it actually didn't survive into 2001.